Well, good morning, everybody. It's 11 o'clock, so we'll get going. As usual, I'm going to be running through the week's news, but we've also got our second quarterly panel show. So this time we've got Nick Greenwood, Peter Hewitt, and Ben Ritchie, and we're going to be talking about discounts. That coming up in about 5 to 10 minutes. So first, bits of news that we've seen since 17th of June, so since Monday. I just picked out two things, one on Home REIT and one on NextEnergy Solar. Home REIT first. Obviously, this is a bit of a disaster, this one. Latest thing is that its negotiations with its principal lender, Scottish Widows, have fallen through. Scottish Widows say they want their money back. Home REIT says it's not really practical for us to refinance our existing borrowing facility. And so, therefore, the chairman is saying we think we need to think about how we're going to repay the debt. And then once we've done that, think about what the plan is for shareholders, which, as he says there, may include just selling everything off. So at the 21st of June, the situation was that they had debt of about 131 million at the end of May and 27 million pounds worth of money to come in from things that they'd sold but hadn't settled yet. They sold another 132 properties for 11.4 million. That's not a lot of money, because the average value of those is 85 grand. And that's indicative of probably where they are and the sorts of property that they are. But disappointingly, they were sold for almost 8% less than they were valued at last August. If you take that money off the money that's coming in anyway, that implies the outstanding balance on the debt now is about 94 million pounds. That leaves them with about 1,600 properties, valued about 300 million quid. And that's an average of 185,000, which is much closer to the national average for house prices. I mean, still way below it, but still much closer. And again, that gives you a skew as to that they've been selling off the poorest quality ones first. But it does imply that once they've sold enough property to pay the debt back, they're only going to have about 200 million pounds worth of property left. So that means that NAV-wise, because there's a little bit of cash in there, it's about 30 million quid, but they're using that to pay all sorts of fees and things they're going to pay. I think NAV is going to be in that range about 23.4 to 25.9p a share. And obviously the whole thing was an auction at £1. So you can get a sense of the value destruction from that. So they're publishing these monthly updates. The next one of those is going to come on the 3rd. They were saying in May that they would publish some accounts by the end of June. I believe that when I see it, because obviously we've been waiting for these for a very long time. These are the August 22 accounts. That's still not enough to get the suspension lifted. They need the August 23 accounts for that, but they said they will follow soon after. So we're just going to have to wait and see what happens. NextEnergy, this one, as we know, with all of these renewable funds, the discounts widened out. This is one of the things we're going to talk about this morning, I think. And it's now trading about a discount of 26%. But that is a bit better than it has been. You can see the sort of uplift that we've got here. And that's kind of related to what I'm going to talk about. So it's decent size and it yields a whopping 11%. And I think that is sort of very attractive in the current environment. What it did was, this week, it sold its White Cross solar plant for 27 million pounds. And they sold it at a premium for what it was last valued at. So that added to the NAV, which is all great. There's a possibility they can run up to 28 million with some kind of earn-out thing. It's a decent amount of money over what they paid for it. So what they actually invested in building this thing. So 1.3 times. And that kind of reflects the situation. If you remember when they sold the last thing, it was Hafferden, which they sold before they built it, but nevertheless was quite a big uplift. So it just shows you if they're given the chance to do these projects, they can make money out of them for shareholders. But the focus at the moment, given the discount, is to pay the debt down and then buy back stock. So they're going to reduce the credit facilities, but they're also going to launch a 20 million pound share buyback program, and that's what's given the kicker to the share price. Now, paying down the debt, this is not a situation where they need to do that. the gearing looks higher than it really is because they've got a lot of preference shares. So these rank below the bank debt in terms of the capital structure. So, and the fact that they're in the capital structure means that they can borrow more cheaply than they could do otherwise. So if it was all debt, then they'd probably be paying a bit more for it. But these last until 2036, if they like. They've got an opportunity to start redeeming them for 2030, but they're fixed rate of 4.75%. And it's possible, but I think unlikely, it's possible they might convert into equity. We'll have to wait and see. But if you knock them out of the equation, then the financial gearing is only about 29%, which is much more manageable. And as I said, because they've got this fixed the preference stock in the capital structure, they're able to borrow much more cheaply. So they're paying SONIA, which is the equivalent of LIBOR, the new version of LIBOR, plus 1.2, 1.5%, which is actually not too bad at all. So that gives them weighted average cost of debt about 4.5%. So it's nice that they're paying the debt down, but it doesn't feel to me like they really have to do this. There is more to sell under the capital recycling program, and I think part of the frustration with the discount before was that they announced this and then nothing happened for a while. It does seem to me, from talking to them and a bit at the results meeting this week, that they are thinking that more disposals are in the pipeline and they're going to come relatively soon. What price they fetch, don't know. But if you just extrapolate from Whitecross, then that'll be about £150 million. That's obviously a decent chunk of money. And they are in active negotiations with these things, and it is a competitive process, so it should be a decent price. Yeah, and then the £20 million buyback is great. If that shifts the dial enough, then they can stop it. If they doesn't, then they can keep going. And they probably, will think about whether they're going to buy back stock or whether they want to invest in new projects. Having said that, I would quite like them to be investing in new projects, given the amount of money that they can make on the NAV. They did announce results this week as well. There wasn't very much exciting and new in there. As NEV fell, but we knew all that already. Power price forecasts have come down. We knew that because there's not so much pressure on gas prices anymore. And also the discount rate that they used to value the future cash flows of the portfolio to calculate the NEV, that's gone up a bit as well. That relates to interest rates. And obviously, hopefully, they're going to come down again. It's now 10 years old, and it's done a decent job. So 103 assets now, a gigawatt of solar mostly in the UK. There's only 16 gigawatts of solar in the whole of the UK, so they're a really significant player in this. Dividends been upped again. That's going to be covered by cash flow. They're pretty confident with that. But because of where we are, there is a discontinuation at the AGM. I think it would be crazy to vote against them at this kind of level. And that goes for all the other ones that are facing discontinuation votes too. So that's enough from me.